thanks everyone for joining us today for a pricing methods webinar. So pricing, as we know, is one of the key levers for more profitable businesses. And today we'll explain a few of the different methods for pricing, some of the benefits and drawbacks of the most used methods, and explain how they work. So if we go to the next slide, I'll quickly introduce our company and speaker today, Ingo. So Ingo will be leading the conversation. He is the co-founder of Buynomics, a software for better pricing decisions. He has more than 14 years of experience in pricing and developed the Buynomics method. So he saw some of the methods that we'll look at today and thought, oh, this can be done a little bit better. And we'll also see how it can be done better. I'm Paul. I'm leading sales at Buynomics. Previously worked in consulting, now with Buynomics for 3 years, helping various clients across industries, be it beauty, food and beverages, telecommunications, etc., etc. And we'll be kind of moderating the Q&A today. If we go to the next slide, just a few words on Buynomics before we start with the content. So Buynomics is a software provider for what we call revenue management decisions. So all the questions that businesses are asking around their top line optimization. So what's my best price? What's my best portfolio? What's my best product to offer? How does it all play together? That's basically where we have a very new method and a very new approach to it, but also a nice software to leverage all of that in one place. In terms of what our benefits are, it's really that core method that Ingo will touch upon today, but also, the resulting accuracy, the speed of a software that comes with that, and in the end, much higher profits as a result. And yeah, we'll see how that comes from pricing today. But I'll hand over to you, Ingo, for kicking us off with the content.
Yeah, thanks, Paul, for the introduction, and thanks to everyone listening to the webinar for taking the time to listen to our content. And I hope that I'm very sure that we have something to tell, so to make your time worthwhile. And without further ado, let's get started into the topic. Before we talk about different methods, just one slide on context. Of course, pricing is always pricing and revenue management more generally are always important topics, but of course they're particularly important in times when pricing is challenged. So, for example, as we had high inflation in the last year, and inflation now seems to be a bit slowing down, so we have massive impacts on what is the right price, be it for profit optimization, be it for revenue optimization, or other objectives that an organization might have. There are, of course, many other things. I won't go into all of the details, but for example, if you have changes in regulation that might take out some of the options that you have in terms of the promotions that you run or the packaging that you use, then of course pricing is always important, an important lever to make the best of the situation. And I always point also to the last point, as we have steeply increasing interest rates and changes in the capital market immediately have an effect on pricing, or pricing can really help also on the capital market of a firm, in the sense that if you are aiming for, or essentially for the trade-off between profitability and growth, if you focus more on growth rather than short-term profitability, you expect to have higher profits in the future. If interest rates are high, then future profits are valued less in the present. So with high interest rates, present profits are more important, and that obviously always has an impact on the decisions in revenue management and pricing in general. So with high inflation rates, profits today are more important than growth with that future profits. And that's something that's always important to keep in mind in our day-to-day work. But so much for the context, and we'll come back to the inflation example because it really highlights a lot of things that are important in pricing. And here's just an overview, and then we'll go into the details. From our experience, there are essentially 5 key methods relevant in pricing. cost plus pricing, competitive pricing, looking for what the competitors do, price elasticity-based pricing, understanding the dynamics or the relationship between price, products and demand, value-based pricing, trying to capture what products or product variations are valued by how they are valued by the customer and how to price them. And then there's behavioral pricing, which goes more into the actual decision making. If you show an offer to your customers, how will they then decide between the different offers? And Paul, I don't know if we have a survey that we can ask the audience what of these methods they're currently using.
I think Jonathan or you as the host can share that with us. I don't see my poll.
I think Ingo should be.
I don't have it.
To do it somewhere.
No, it's not here. Let's do it next time. Yeah, maybe you can put it in the comments. If there's anything you find that we're missing here from the list, please let us know. Happy to discuss it in the end of this webinar. Or if you find that some of them are not important, then please also let us know. Happy to discuss this. And now let's go into some of the details here. So I think the starting point in pricing, and if you as a company or maybe as a small business are not spending too much time on the topic, then most of these will use some form of cost plus pricing. And the idea is very straightforward. You know the cost, the variable cost of your products. You add a markup on the costs, and that essentially gives you your price. And I would say one of the classical examples is the pricing of restaurants, where many restaurants work with the logic where they add up 300% on the costs of prepare or the wholesale cost of a meal, which implies a 75% margin before rent, labor, and all of the other costs. And that's something that works very well for smaller restaurants. This is something established. And of course, cost plus pricing is in the pricing community always looked at pretty much downwards. It's portrayed as being worse than I think it actually is, because it also has some advantages. It has the clear advantage that if costs increase, you can automatically have an immediate rule to pass on the cost increase. Cost increases as a cause for price increases are typically very well accepted by buyers. So that's often also in situations where a cost increase is not triggered by a price increase. Many companies use the narrative of a cost increase as a justification for price increases. So there are some advantages to the cost plus pricing, but of course there are also very clear and immediate disadvantages that are always pointed out. And I think the two most important ones are that it doesn't really consider value to the customer. So in the example of the restaurant, if you just put the 300% markup on the wholesale cost, it completely ignores the ability of the cook to make the most of the meal. So it doesn't really consider what's going into, and it also doesn't consider what customers of the restaurant are actually willing to pay for a meal. So clear disadvantage, and of course, if you're in a competitive environment, it also ignores the competitor pricing. So very, very simple. I think it's a good starting point, but it ignores a lot of the stuff that's really important in pricing. The next one, competitor pricing, very similar as a logic, but instead of the cost, you start with a competitor price and then have a markup. And here also different from the cost plus method, also a markdown based on a competitor price. And typically companies work with a sort of price leader when there's a clear leader in a category with a large share of the large market share. It makes sense for all the smaller ones to base their pricing on that price leader, or like a competitor basket of, let's say, the 3 biggest competitors in the market, and then say, okay, we want to be 5% or 10% above or below that market price. depending on how companies see themselves in terms of the quality relative to the competition. And it's has, of course, clear advantages. It makes pricing just like the cost plus pricing very simple. You don't have to do research in terms of how have preferences changed in the market, how has the competitive environment changed. You just look for the market leader. If that market leader does all of the research that's relevant in the market, then you sort of benefit also from that research if you just follow the guidance of that price leader. So it also makes pricing very simple, and also it has sort of an effect in the market. The price leader knows what that a large share of the other competitors are following, and that also makes the pricing easier for that price leader in the market. So also some clear advantages, but also disadvantages in that it typically ignores costs, and it also ignores value to the customer, because you're not really looking at willingness to pay, you're just looking at your competitor. And there are cases where pure competitive pricing can really spin out of orbit. I think the most famous one is it's called it's a biology book on flies, making of a fly, and there were two competitors who essentially priced off each other in a way that on Amazon, because no one was really buying that book or interested in that book, and when then someone looked at the book, and that has been going on for quite some month, the books were priced in the millions, because one was always trying to be, say, 5% above the other, and the other was trying to be 5% below. So they were really spinning out of orbit based on each other. So these things can happen with the pure competitive pricing, but again, it's a very simple method that has the disadvantage of typically ignoring costs and also ignoring value to the customer. I would say in most practical pricing that I've seen, the most relevant is price elasticity-based pricing. And the focus here is really to understand or measure the relationship between price and demand. So it answers the central question. If I go up with my price, let's say 1%, how much units or how much sales will I lose? And essentially the price elasticity is just that number. It's the relationship between price change and demand change. So if I have a price change of 1% and I lose 2% demand, then my price elasticity is -2. I just divide the two numbers by each other. And I would say the most important insight on price elasticities is the relationship we have here on the right side of the slide. And that is, if I know my margin and my price elasticity, I also know where the profit optimal price is, because in the profit optimum, I have always margin times price elasticity is -1. So to me, that's the most relevant rule for if you're working with price elasticity-based pricing. It only is valid, of course, in the one product world that we have here in the graph. So if you only have one product, then it's strictly true that if your margin times this is -1, that you are in the optimum. If you're managing a portfolio or you have competition that also might react to your pricing, then of course that formula can that doesn't necessarily yield the optimum. But if you're just looking at a single product, it always does. So for example, in this case, you have costs of 100 euros. You have a price elasticity of -2. That means the optimal margin is 50%, and that produces a profit optimal price of 200 euros. Also, maybe important to note is if you're not aiming for profit maximization, but rather for revenue maximization, then the revenue optimum you always have at the point where the elasticity is -1. So this will give you the revenue optimum, and you already see that the profit optimum is always in an area where the price or the demand has become more elastic. So simple example is that we would come back to the inflation scenario. A typical question is, my costs have gone up by a certain percentage. What is the profit optimal price reaction to that change? And that's also very straightforward, but it kind of depends on what type of demand function we have. Let's say we have a linear demand function, which we always have. So we always use the same number of units for the same absolute price change. Then the profit optimal is determined by this formula here. And that means we always need to pass on half of the absolute cost increase. Whereas if we have exponential demand, so this function here, also the one that we had on the previous page, where the price elasticity is constant, that means we always pass on the percentage cost change. And that can produce quite some difference already. So let's say in the previous example, we had costs of 100 euros, and the cost increased from 100 euros to 110 euros. And the old profit optimal price was 200 at a price elasticity of -2. That means that under linear demand, we should pass on half of the absolute change. So that would lead an optimal price of 205, and in exponential demand, it would lead to a profit optimum price of 220. So quite different. So just as a reminder, if you're working with price elasticities, it's not sufficient just to know the price elasticity, but you also need to know how it changes with a price change. So particularly in this example, does it stay the same as it is on an exponential demand curve, or does it change as on a linear demand curve, where the price elasticity is different in every spot? So these are things, if you're working with price elasticity, that are very useful to know to do the right thing. Another very important pricing method is value-based pricing, which is like a large assortment of all kinds of different ideas. But I think the core idea is always to try to understand what the product or the value drivers or attributes are worth to the customer. So you always put the customer in the center and try to understand what is the product worth to the customer. And we have here this example with ski jackets that have different variations. So we have different fillings, down filling and synthetic filling, and it can be waterproof, more or less waterproof essentially. And what we've determined, let's say with some customer survey, is that a simple ski jacket has a starting price of $100 with water filling here, with synthetic. With down filling, the willingness to pay goes up $50. With water column goes up $50 again. So these are the preferences of the shoppers, and that produces here in the end an optimal price for this particular jacket here of $350 if the two markups are added, and it produces a lower willingness to pay if you go to the one below. So essentially what you do, I think something got wrong here with the numbers. We'll correct that in the deck when we send it out. But the basic idea is really to differentiate the price of different variations based on the value drivers and attribute levels that are used to produce them. Typically, this is used when you price a larger portfolio where you have different variations of a product. And I would say the key benefit of the method is really that it focuses on what's really most important for pricing value to the customer, but it also has a number of disadvantages that are often not fully mentioned. So one is, of course, it also ignores costs. If you only focus, as we do here in this example, focus on the willingness to pay the value to the customer, you can ignore cost, and often you also ignore competition. You can incorporate competition by starting with a competitor price, but then you also look at not what is something worth to the customer, but more what is it worth, how much does it value differently compared to the competitor in the beginning. And I think often a very important disadvantage of value-based pricing is by building a price structure like this, it kind of ignores the dynamics between different products, so the trade-offs. So it doesn't consider how it might be worth to the average customer or a certain customer segment. Difference might be these 50 euros here, but it doesn't consider how do people actually choose between the different products, if the difference is 50 euros or it's more than 50 euros. And of course, one final difficulty in this method is that it's really often really difficult to really assess how customers value these different products. So how certain are we that the more waterproof product is valued $50 more than the less waterproof product? So these things often require a lot of research via surveys or other measures, can also be deducted from sales data, for example. But this is a more difficult exercise than the exercises we did in the previous methods, where we just did a cost plus, or just looked at what cost these products cost at our competitors, for example. The final one, behavioral pricing, often also a very important method, and the idea behind it is really to understand the decision making by shoppers. So how do they actually choose? If we have something like a good, better, best offer here, how do they really choose between them? And one thing, for example, that we often see is if you show people 3 options, that they tend to go for the middle option more often than they would if they were purely rational in their decision making. Also, it can be very impressively shown with research that if you show something like best value for money here in the middle and you highlight a product, that this also steers customers towards a certain product. And this is typically easier to do or more successful if it's difficult for customers to really assess the value of the products. In situations where it's easier to assess the value of products, so for example, if you're pricing a mobile plan as a telco company, and you have different data volumes, and customers have a good understanding of how much data they need per month, it's much more difficult to steer customers towards a certain product than, for example, in a situation, and I think the standard situation here is the wine bottle example, where you have 3 types of wine bottles, let's say one for 10 euros, 30 euros, 50 euros, and people don't really know how the value of each bottle. And you can, by introducing an expensive bottle here, you can steer customers from a cheap to a more expensive bottle. So behavioral pricing works better in situations where it's difficult for customers to really assess how much they value certain products. And of course, there are many other ideas in behavioral pricing, like price thresholds and other ideas that are important. And typically behavioral pricing is not used as a standalone solution to set prices, but it's typically used in combination with other ideas. So for example, and this leads us to the aggregation of all these different methods, because in most practical pricing that I've seen, none of them are just used in isolation, but they're really used in combination with each other. And one typical approach to combine these different methods is the one that I've highlighted here. I think this is one of the more sophisticated methods. I would say the least sophisticated I've seen is that teams have essentially determined these 4 or 5 prices. So they computed a cost plus price, a value-based price, a competitive price, a price elasticity price, and then just took the average of the 4 and maybe did something with behavioral pricing in the end. But I think a decent approach to combine these different methods is really start with the costs, have something like a base margin, then differentiate prices based on the value drivers, check in the end for the competitor pricing, and do this also in the context of understanding, using price elasticities, what the demand for each product and what the profit implications are, and then do some final price checks. For example, price cosmetics, if the price you compute in the end is, let's say, 300 euros, you would it often makes sense to then go to, let's say, 299 or 299.99 and so on, that you apply some price cosmetics which belongs to the behavioral pricing world. So this is a way to aggregate them. But of course, these different methods often go counter each other. So when you, for example, you have applied your value drivers, you have a price structure as we had with the ski jackets, and your competitors are thinking of a different price structure or don't have a structure at all, then this might mess up your consistency here to some extent. So these are things that are important to consider. And before we close, I want to just very briefly show a different way, or I would say a more advanced way to bring together these different ideas. And this is the method that we're suggesting here at Buynomics when we have what we call virtual shoppers. And the ideas, just go into this for just a minute. We create, essentially you're thinking of lots of shoppers, not 2 or 3 market segments, but say tens of thousands, hundreds of thousands, all like real people with different preferences, and you show them an offer, your own products or your competitor offers, and each one of these virtual shoppers makes an individual decision based on preferences for different brands, different product sizes, product types, and so on. As in the ski jacket example, some value synthetic or downfilling very highly, others don't. And some of them prefer, let's say, a middle options, others don't. So you can really build a model where you really replicate the real decision making in that real shoppers would have. And let me just very quickly switch my screen. Maybe Paul, if you see my screen, please let me know that you see it. The browser.
Yes, I can see it.
Okay, perfect. So just very briefly, here put together an example where we have different peanuts that we're selling in a market, and they have value drivers considering like the value pricing approach. They have different sizes. We have different brands. We have our own brand. We have competitor brands, also considering with this the aspect of competitor pricing. And we have costs, trade terms if we're selling through retailers. So we have really replicated our real cost structure, all the dynamics that are relevant in the market. And this really allows us to bring together all of the different dynamics. So I could, for example, see what happens in this top product here if I increase my price 20 cents and then I lose units. And some of the shoppers that we're losing will go to my other products, so they stay within my portfolio. Some will go here to a competitor. Some will go completely out of the market. I can look at the price elasticity, which in this case is very high with 5.5, minus 5.5. But I also see that when I change the price of an alternative, of the closest alternative here, the just a little bit smaller brand, I see that price elasticity goes down because the most relevant alternative has become less attractive. And this sort of model where I have won't go into detail, but if you're interested, happy to discuss afterwards, after the webinar, where we can replicate the full dynamics that are relevant in the market. So we're considering the cost of the different products. We're considering what happens with competition. See that when competitors change the price, how that affects us as well. We're considering the price elasticities because we can really compute the situation-specific elasticities here that are relevant. We can consider behavioral effects as we have a portfolio, and the switching between the different products and the different price points here. We're looking at specific price points is considered by the method, and it really naturally combines all of these different aspects. And that will be the last thing I'll mention in this webinar, is that let's say we have something like we're in the context of inflation, our costs go up, and before we change price, we see that if we don't do anything, of course, costs go up. Customers will not notice it unless we change the price. So units stay the same, profits go down because our costs have increased. And I can really then look what happens if I also increase my price by 20%. So I'll sort of apply sort of a cost plus. pricing in this situation. I see how that affects my profitability. I can see what happens if my competitors also follow. Typically, that reduces elasticity, so that demand increases if competitors also follow the price increase. And I can also look at different options. So, for example, a downsizing where we go from 250 to 200 grams. So we reduce the size of every product by 20%, keep the price the same. And in this case, we see that would be less profitable than the price increase alternative. So this really, in a nutshell, I think is the more modern approach to combining these different methods. And with that, let me just share my presentation. Paul, do you see the presentation again?
Yes.
Perfect. Just to go back
it's
to this.
It's in the presentation mode, so you need to show me you need to switch the screens. Yeah.
Okay.
Yes.
So with that, Paul, hand over to you. Hope we just.
Yeah. Thanks, Ingo, for the overview of all the pricing methods that we see mostly in the market. I had a good conversation here in the chat with Bruno, who was saying value-based behavioral are the hardest to do right, but the most effective as it pertains to actual consumer expectation. Not much to add there, Ingo. I think this is also pretty close to our view. Right?
Yeah, it's difficult, but if it works well, it's the one that makes most sense, and that's also said in the beginning. Like cost plus is good, and that's why we use the example of a restaurant where they don't have typically the resources to do much research. They need a simple and robust approach. Large organizations, of course, make sense to go more for the value and the combination of the different approaches.
Yeah. And I think Keitan answered in the chat as well. And conjoint analysis can help to get value-based indications. So this, from my experience, is indeed one of the most commonly used methods. Do you want to comment on that shortly?
Yeah, so conjoint, of course, is one of the key methods, has many advantages because you can not only ask for the value of existing products, but also of new variations of products or new features or new brands that haven't been in the market. So you really get insights on these. The challenge is, of course, always that typically you're using a limited sample size. If you're asking 1,000 or 2,000 respondents, there's some noise, so because 10 to 20 people are 1% market share. So it works okay for large products, but not for the mid-market or the long tail. And of course, often you have the challenge that people are not giving a good answer because it's not like a real buying decision, but it's one that also looks and feels a bit different from the real one.
All right. I think in the interest of time, Ingo, let's go to the next slide here, just to see what we have on our agenda here. So we have another expert webinar coming up. And then after that, we will have pricing horror stories, which is a bit of an anecdotal journey through pricing before continuing with pricing tools from the pen and pencil area via spreadsheets to SaaS. So if you want to sign up for any of those, just look into your inbox later today or on Monday, and you'll receive the invite as well. And we will start another expert webinar series soon. So watch out for that, where we will learn from actual, pricing and SRM practitioners about how they build their organizations, build their teams, think about the topics, etc. So we have more content in the pipeline, and follow us on LinkedIn to stay in touch with that as well.
Yeah, thanks everyone for attending. Friday 13th stole our survey, I think, or I didn't find it.
Oh yeah, that was fun.
Anyway, thanks everyone, and have a good weekend.